Hello everyone, George DeSantis here with a special issue of the Look at the Market. During our family meeting yesterday, the issue of protecting our gains when we have gains in a stock or an ETF or other instrument. How do we protect those gains? And so I'm going to attempt to give some answers, not claiming that they're the only answers or not claiming that it's an exhaustive list of possibilities, but I'll try to answer that question by giving you some of the answers that I know. Okay? All right. So before we start, here's the disclaimer. The disclaimer again says that I'm not a licensed professional investment advisor, and if you need such advice, you seek someone else who is so qualified. I'm a psychologist. I do this for my own purposes and share it as a YouTube video. Anyone can take a look at it and do whatever they wish with it. So let's begin. So let's start with the stock Roku, for example. You see that Roku went into what is called a Bollinger Band squeeze here, where the volatility dropped a lot, and as opposed to what it was here. There was very low volatility, and that's what the squeeze is about. And then it shot up. It rode the two standard deviation line all the way up. So it was overbought by this signal here, by this measure here, standard deviation. But then at some point, the stock becomes overbought, so much so that it begins to, some sellers begin to come in here, take profits, people who owned it here taking profits here, and the stock begins to go sideways to consolidate these gains. Okay, so let's say that you bought Roku, but soon after you bought it, it dropped all the way down by 6% or more. Now, Investors Business Daily, or IBD, suggests that if you buy a stock and it drops by 8%, admit you made a mistake or you bought too soon or whatever, and sell it. Don't allow an 8% loss to become larger than that, because the the gains you have to make to gain back what you lost, that 8%, will be as much as 12 or 15%. And the more you lose, the more that stock goes down, the larger gain you have to get back to even. Okay? So don't let a stock drop more than 6%. So that's one of the ways to to protect you to the downside. So let's stay with the Roku chart and talk about a second approach to protecting your gains. Okay? Well, this is really the first one to protect your gains, if because the one I just spoke about with the 6% loss, 6% loss, you're out. You want to protect from further downside. Now, suppose you bought it, it didn't go down 6%, and it went all the way up, nice gain, and now the 4 EMA, that yellow line, crosses below the 9 EMA. That's one of my sell signals. I will want to sell at this level here. Right here, I'll be selling. Okay. Now, if you sold here, you protect yourself from all of these losses here. So instead of selling at 443, if you didn't, you would be dropping all the way down to 300 points or so, and that's a significant loss here. So that would be the first protection for protecting your further losses, and that is sell when the 4 crosses below the 9. All right? Now, the third thing I want to mention is standard deviations. So you bought the stock earlier, it rode the 2 standard deviation up, all the way up here, pull back a bit, went all the way up and hit the 3 standard deviation line, consolidated, and did not really go much further than this, and then it pulled back. Now, you might want to take some profits in this area here when it hits the 3 standard deviation line particularly, just as you would also have done here when you hit and surpass the 3 standard deviation line. If you took your profits here, you wouldn't have to wait until the 4 crossed below the 9. But should you miss this sell signal of 3 standard deviations, you can take this one. So that's another method of protecting your gains. And by the way, we're looking at a daily chart here. Certainly, it depends on the time frame you're using to do your trading. Okay, but this is a daily chart, and that's what I would normally use. Now let's take a look at Jake Bernstein's chart. This is again a daily chart. He uses a moving average of a 3-day moving average of the lows. Well, a 3 period, in this case it's a day, 3-day moving average of the lows, and that's plotted in this magenta dotted line here. So you can see that you have a setup here because the accumulation distribution line is below the moving average. So we'll call that a setup. And you have a trigger here of you have these two complete successive bars below the 8-day moving average of the lows. So that would be another way of protecting to the downside. So you would have been looking to sell here. In addition to that, if you were using the stop loss of the 8-day moving average of the lows, when you close as you do here, when you close here below the 8-day moving average of the lows, that's your sell signal. That's one sell signal in form of a stop loss order. Okay, and if you got two successive bars below the 8-day moving average of the lows, and you have your setup here, this is trigger, and you have your setup here, that's a sell signal. So that's another way of protecting if you had a gain. So yet another way of protecting your gains. Let's say you had a nice gain all the way up here, and you get to this point where you see that the MACD histogram, this one, where you get your sell signals, it drops below the zero line. So you get a sell signal here at this level. So it's pretty much where the 4 cross below the 9, as you can see up here. That's exactly where that MACD, the 1939.9 MACD gives you a sell signal here. So that would be another way of protecting you from this further loss or drawdown here. Yet another stop loss order is what my friend Alex Elder uses, and that is 1.5 or 1.5 the value of average true range. Okay, so this is this white dotted line here. So right now this stop is right here at about $406. It's pretty low compared to where the price of the stock is. So the 8-day moving average of the lows actually follows the price more closely in most cases. In some cases, they switch around. You see, you can see that they switch around here. But that's another one, that's another stop loss. 1.5 times the average, the ATR, average true range. And let's take a look at another one now, another topping pattern, if you want to call it that. I think you could make a case for head and shoulder pattern here. Here's your head, here's your left shoulder, here's your right shoulder. And soon after that, you got this pullback. Okay, so that's your head and shoulder pattern. I'll show you another possibility. I think you could make a case for a double top here. See, you see this, the shadow of this candle here and the shadow of this candle, double top. So a double top very often leads to decline. So that's another way of protecting your losses. The other thing relative to this is that you have a shooting star. When you have a long shadow like this, you have a shooting star, or sometimes what I called jokingly the finger. You got the finger here, baby. You better get out. And soon after that, the 4 crossed below the 9. But this candle gave you the finger. Gotta have some fun with this, right? Now, another way to protect your gains is to look for divergences. So, for example, right here we have well, let me first talk about the formula for the triple momentum indicator and the momentum indicator. You're not going to be able to plot this on most software packages. This is a formula that I wrote for TC2000. But you can certainly find a rate of change indicator on most packages, whether it be Fidelity or TC or whatever. So I made a suggestion to Mike on the family meeting that if you cannot do this, why not pick 15 as a period? In other words, the 15 period rate of change and see how it lines up. Well, take a look at what we get. If you use the 15 period rate of change, you'll actually get a divergence here from a higher high here. The market made this high and dropped down, and then it made a higher high, but the rate of change made this high and then a lower high as the market made a higher high. So you got a divergence of the rate of change. So you could actually use this 15 period rate of change to give you very similar signals as the sum of the rate of change indicator that I use, or what Jerry Appel calls his triple momentum indicator. If you take a look at the chart here, as the indicator crosses below 4%, I'm using 0 here, right? It's almost identical in terms of the signals. Right here, when it crosses back up right here, when it crosses down here again, right here, right? And so you can use this indicator to mimic this rate of change, or a triple momentum indicator. Okay, that's one way to do that. Now let's take a look at MACD histogram. And what I notice here is a bearish divergence of MACD histogram. The same divergence we saw with the rate of change indicator with the 15 period. You can see it here with the MACD histogram. Look, the market made a high, it pulled back and made a higher high. MACD histogram made a high, pulled back with the market, and then when the market made a higher high, MACD histogram made a lower high. So you get this divergence on MACD histogram. In fact, on both of them, the one we usually take sell signals from the 1939.9 gave you this bearish divergence, and then you got this big drawdown here, So you got a divergence of MACD histogram, and that's yet another way of knowing if to sell, etc. Now let's talk about the parabolic stop and reverse. So you have an uptrend here, and the parabolic is below the bars, right? And then it switched to being above, so you certainly got to pull back here. Then it switched to below the bars again, and you get this run up here and vice versa here. And then in this case, you got another switch, right? And you got another switch here. So parabolic is very sensitive to price movement, especially the parabolic that I use, these settings here, 0.07 and 0.2. So you can also use the parabolic if you're doing more short-term trading, but it's very sensitive, so you have to be aware of that, okay? Now let's take a look at how you might trade a triangle and protect your gains, take your profits. So you have an A, B, C, D triangle, and the breakout level is approximately 332. I mean, this is somewhat discretionary here. You have to draw a line, like here, where the breakout level is, where the apex comes together. You know, where you come to the apex in the triangle. So when you take this 397 and subtract 272 from it and add on the 332, you get 457 as a target from this triangle. So let's say you bought it on the breakout of the triangle and you wrote it all the way up here. This is one of your sell signals, or sell points anyway. If the stock gets a little higher up here to be 457, some people might prefer to start taking profits here. The stock is going sideways and consolidating these gains, but it's likely to get to the target, but they don't always hit the target. So 457 would be somewhere around here, you see here, right? And it might get there, but then again, it might not. So you have your judgment. You have to make a judgment as to whether or not you're going to wait for it to pull back to get stopped out here. They move the 3-day moving average of the lows, or you take some profits. So in summary, there are lots of ways to try to protect your gains. And I've shown you a number of approaches to do that. And I certainly haven't exhausted all the possibilities by any means. But I hope that this helps you to take a look at some of these and decide which ones seem to fit your style of trading, okay? And the availability of software, what software package you use, and whether you could plot some of these things and use them. I hope this helps, and good trading. If you have any questions, don't hesitate to send me an email. All right? Thanks for listening.